Our today's topic is interest rate risk, the repricing model. As usual, we have few learning objectives in this week. So first of all, we will discuss how Reserve Bank of Australia, the Australia Central Bank, can influence interest rates in the market. We will discuss how modern financial institutions typically mismatch the maturities of their assets and liabilities and expose themselves to interest rate risk exposure. We will discuss repricing model, a technique to find out financial institutions' interest rate risk exposure. And finally, we will discuss some weaknesses of the repricing model. So first of all, we discuss the level and movement of interest rates and the central banks of Australia, that means RBA's role in this level and movement. So, many factors influence the level and movement of interest rates. It is central bank's monetary policy strategy that most directly affect the level and movement of interest rates and that ultimately affect financial institutions' cost of funds and return on assets. For example, if the central bank smooths or target the level of interest rates, in that case, unexpected interest rate shocks and interest rate volatility tend to be small. The risk exposure of financial institutions from mismatching the maturities of its assets and liabilities in that case tend to be small. On the other hand, to the extent that the central bank targets the supply of bank reserves and is willing to let interest rate find their own levels, that means if central bank let the market to determine the interest rate, then the volatility of interest rate can be high. In 2001, the governor of Reserve Bank of Australia, RBA, raised two important questions. Why does the Reserve Bank have to change interest rate at all? So why can't they left constant? And why does the Reserve Bank have to be involved in the first place? Why can't the determination of interest rates be left to the market? Well, the issue underlying this question is why there is a need for mechanism other than the market to influence interest rates and why interest rates change are not left solely to the market. The RBA has the medium-term inflation targeting as the framework for monetary policy in Australia and seeks to achieve a rate of increase in the consumer price index between 2 and 3% on average over time. The impacts on inflation are in the main domestic, but at the same time, the RBA keeps a close watch on the global economy and global financial markets as global developments could outweigh domestic influences. So altogether, RBA actually target a cash rate to maintain the stability in the financial market. Figure 5.1 in this slide shows the movement in the CPI from 1990 to 2013. And from this, you can see that while any time the CPI may be above or below the cash rate, or the targeted range, the average since 2001 is usually within RBS range. From the figure, we also see a general correlation between the inflation rate and RBS cash rate decision, because you can see that when the CPI tend to decline, RBA cash rate tend to decline, and when the CPI tend to increase, RBA cash rate also tend to increase. It means that when inflation is on the increase, the RBA generally increases its targeted cash rate and drops the target rate when inflation is falling. I will come back to this slide shortly. The RBA's management of monetary policy is not confined to the announcement of a target cash rate that we just discussed in the last slide, but it occurs daily through its open market operation where it buy and sell treasury bonds, treasury notes, and sometimes the other securities in the secondary market. From your basic economic course, you know that a central bank sell the government securities to the market to control money supply in the market that ultimately affect interest rates. Now, for example, when central bank wants to restrict money supply, they sell government bonds to the market and take the money back from the market. On the other hand, when central bank wants to insert more money in the economy, they buy back the previously sold government securities and circulate more money in the economy. Through such operations, the RBA influences the money supply, inflation, and level of interest rate until the target cash rate is reached. Changes in interest rate will then impact economic decision by both businesses and consumers. Business investment and consumer investing or spending will stimulate economic activity, whereas a decline in spending and business investment will slow the economy. If the RBA believes that it needs to stimulate the economy, it may implement a looser monetary policy by lowering the interest rate, thereby promoting business investment and consumer spending. Conversely, if there is a need to slow the economy, RBA would tighten monetary policy through higher interest rates. The role of RBI in assisting to counter some of the market shocks caused by the GFC from 2007 and 2009 is an interesting case study. If you look at the graph in this slide, you can see that yields of 10-year Australian Treasury bonds from 1985 to 2013. The first observation is you can see the degree of volatility appears to have been high during the late 1980s through the mid 1990s. And it is also interesting to note that the market volatility during the GFC from 2007 to 2009 was far less than market volatility during the late 1980s and late 1990s. The second observation is that the relative degree of volatility or interest rate uncertainty appears to be linked to the RBA's monetary policy strategy. For example, until the early 1970s, the RBA focused on interest rate controls, undertaking activities to target interest rate goals. This approach was abandoned in the mid-1970s when the central bank moved towards monetary targets or conditional projections of money supply growth. This increased the volatility in interest rate over the ensuing period that we have discussed already. With the deregulation during the 1980s, there was a move back to interest rate smoothing from 1985. However, the effects of these are difficult to see from this figure until the late 1980s due to the impacts of both the 1987 stock market crash and the property crash of 1988 and 89. With interest rate targeting, we see far less volatility of interest rate during the 1997 Asian stock market crisis and also the Asian financial crisis and the 2002 terrorist attack in Bali and the GFC from 2007. Regardless of the reasons, interest rate volatility exists and creates uncertainty earnings and capital values for all financial institutions. That's why it's important that financial institutions effectively measure their interest rate exposure and take position accordingly. In the next video, we will learn the repricing model that financial institutions use to measure their interest rate risk exposure. Thank you.